And this target that we get out of here is way, way up at $330 on a log scale chart. And then we see 600, and then we will see 4 digits. We've called for a single digit gold silver ratio in an overreaction moment period. That means 9.99 potentially or lower in gold silver. So you could have a situation where gold is, 15,000, 25,000, and you could, wherever it's going to be a very strong high, localized high, it could even be 108,000. That silver is 1/10, less than 1/10 of, more than 1/10, my apologies, of the gold price.
Francis Hunt, widely known as the market sniper, has issued a bold and far-reaching outlook on silver, calling it one of the most asymmetric opportunities in the entire financial system today. He argues that silver's current market dynamics are setting the stage for a historic revaluation, one that could redefine how investors view money, value, and tangible wealth. According to Hunt, silver remains grossly undervalued relative to gold and other assets, largely due to years of price suppression, paper market manipulation, and investor disinterest. Yet, beneath this surface calm, a powerful structural shift is brewing. He points to tightening physical supply, record industrial demand, and growing distrust in fiat currencies as catalysts that could ignite an explosive rally. Hunt emphasizes that silver's dual nature, as both a monetary metal and an industrial commodity, makes it uniquely positioned for an era of financial instability and technological transformation. On one hand, investors are seeking silver as a hedge against inflation and currency debasement, mirroring gold's role as a store of value. On the other, silver's critical applications in solar panels, electric vehicles, and electronics are fueling unprecedented industrial demand. Hunt notes that this dual demand profile is creating a perfect storm, where both financial and real-world forces are competing for a metal already in constrained supply. He believes that once the disconnect between paper and physical silver markets becomes undeniable, the price could reset violently higher. In his analysis, Hunt highlights how the global monetary system is accelerating toward a breaking point. He describes the fiat system as a debt-based illusion, where ever-expanding credit and money printing have detached currencies from any tangible anchor. As confidence erodes and debt spirals out of control, investors will rush toward hard assets, particularly silver, as a form of monetary protection. Hunt envisions a scenario where a single systemic shock, such as a major banking crisis, sovereign debt default, or geopolitical escalation, could act as the trigger for silver to go absolutely vertical. Once that event unfolds, he predicts silver could experience a rapid and violent revaluation, surpassing even the most optimistic forecasts. Before we dive into Francis Hunt's sharp insights from their latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
Ref, the final point you made about Morgan Stanley and that allocation, the investment banking cartel, and they have been a cartel, are largely responsible for the fiat and debt debasement. They've worked hand in hand with state to bring this about. I'm quite contemptuous of their sudden virtue and their attempts to get in front of a narrative once clearly things are shifting in a market. What tends to happen is it's almost like, I use this rather, JP Morgan and Morgan Stanley, etc., we all live in a communal home and they've been defecating on the porch. And they are part and parcel of bringing the standard of living in the communal home immensely down. And then they run around to all the other commune members and go, hey, watch out, it stinks like hell out there. Don't sit out on the veranda, as if they're the warners. They got their losses socialized and their profits privatized in the events of subprime. And what people don't realize as part of CB19 is the Federal Reserve lent over 21 to 23 trillion to banks. Lent, we have no idea what those terms were, and those articles have been immensely suppressed. And for the Americans' ire, let me also add, some of the recipient banks weren't even American banks. They involved some Swiss banks and one or two others. So the Federal Reserve debased your dollar increased debt and created loans that probably can't be paid back to make whole banks again with whatever derivative positions they had with regards to this ongoing Ponzi scheme. And what we're finally seeing is the cracks in the dam wall I was referencing and far higher levels of water coming down the river. And we're the guys that want the water sports. We built our houses on the high ground. We want to fish again. We want otters and beavers and deer and everything to come and drink down there again. There are other people that built right by the riverbank on the basis that it would never flood. And what's happening is those that don't see gold are those people. They don't recognize sound money for what it is, are those that are right on the riverbanks that will be washed away. And those, you and I, are those on the higher lying areas, well away from the future flood, but are looking forward to being able to fish again. And that we're starting to see them having to open all the sluice gates and some of the water coming over the rim. And yet the debt is continuing because you can't help it. You're borrowing to pay interest, continuing to be a parabola. So it's like all the glaciers upstream are melting, and not only are we flowing over the rim, but the volume of water is now coming so much faster. And that's what gold is showing. It's actually a great concern that we will be, a small group of very wealthy people in an environment where many will be deeply, deeply fiscally.
Hunt also examines the gold-to-silver ratio as a critical indicator of market imbalance. Historically, the ratio has averaged between 15-1 and 20-1 in periods when both metals were freely traded monetary assets. However, in recent years, the ratio exceeded 100-1, reflecting a massive undervaluation of silver relative to gold. Hunt argues that as gold continues its steady ascent, silver's inevitable catch-up could be spectacular. A reversion to even a 40-1 ratio, assuming gold trades near $3,000, would imply a silver price above $75 per ounce. But if silver overshoots, as it often does in parabolic phases, prices could easily extend into triple or even four-digit territory over time. Another key element of Hunt's outlook is the role of psychology and market timing. He believes most investors underestimate how quickly sentiment can flip in a thinly traded market like silver. The moment institutional money recognizes silver's leverage to gold and its scarcity, the scramble for physical ounces could trigger a classic short squeeze, similar to what occurred in the 1970s bull run but on a far larger scale. Hunt suggests that once the silver market breaks key resistance levels and breaches major psychological thresholds, momentum traders and algorithmic funds will pile in, pushing prices into uncharted territory. This fear of missing out phase, he says, could create exponential gains for early holders.
You can always go back on holiday there in time and it'll get cheaper with every visit that you make if you've moved outside of that Western hemisphere, including Japan. But it's not a popular message. It's that bad. And just to highlight that, I say, I'm a better surfer than Kelly Slater. Because I've given him an ironing board and I've sent him on the flat Mediterranean Sea and I've got a proper piece of kit and I'm down Cape Town where there's real waves. In that environment, I outperform him because he has been ill-equipped and been put in a useless environment for competing with me. So even the best, hardest workers will battle in a depressionary environment. Unless you move into the mortuary business, which probably will do quite well, and the antidepressant business, which is largely sewn up by Big Pharma. Anyway, enough on that. That's point number one. Point number two to the template is that two forces can simultaneously exist. One is recessional forces, the consumer being damaged, the demand not being there, and you're talking about part of that cost of living that I referred with the fiat and debt debasement, which has already begun and is having its effect. And within that, you can have effectively what is an inflationary force, which is the fiat devaluation, the debasement. Those two can coexist. It's kind of like global warming and global dimming, et cetera, et cetera. These things can happen at the same time. That's not a vouch for climate change, by the way. I'm on the other side of the world on that. But what people only notice is the net effect of these canceling out forces. And they fail to realize that these things can exist. Why do I say that? Everybody is saying, wow, all the influencers on X, and we've made two big calls involving oil. In 2019, we called for single-digit oil. This is early 2019. We repeated in August, regularly on our YouTube channel. We were in an event in November, and then we were on a stage in Acapulco in February. All throughout that time, the oil was $67 or higher, and we said single-digit oil. And what the other part of that trade was long gold. So the 2019 that then ended up at the 2020-21 high, long gold, short oil, which was a perfect delta hedge that if there was inflation and oil actually went up, you would also be benefiting in the gold. So it was actually, by having two legs, more neutral. Oil traded zero, and in the futures markets negative, and gold made a localized high in the tail end of 20 going 21. We recalled that exact same trade a year ago and I will show you the charts when you're happy to do chart share. I know you want to have dialogue first, and I'm still answering your first question. But we called it the exact same inverted head and shoulders on gold relative to oil, and said, not only is this a reversal and it'll run from, it was as low as 14 barrels you got on a gold ounce when oil snapped back after CV19 events. It went as high as 129, you might recall. And you only got 14 barrels. We said we're going to 63, and that's going to be the target. But in actual fact, after that, you're going to continue a reversal to new highs. What happened? The crisis is a fiat and debt crisis as a result of the additional proliferation that occurred in CV19 that suddenly brought debt straight to the forefront. This is a debt problem. This is a debt debasement problem, and the fiat is a part of that. And oil goes down on account of the recessional consumer. We have a two-tier economy, which has the insiders of NVIDIA and server centers and Palantir that are stuffed with government contracts on debt. Remember, America spends more than it gets in, almost twice. And they are having a feast. But that is a twisted balloon, you know, the clown that makes something for your kid. There's two halves. The other half, the consumer half, your half, private businesses, is all being crowded out by state. We're going from a capitalistic small state model and price discovery and light regulation into largely government as everything. And we're in the tail end of the private business world, and it is being deflated. And that's where most of us live. And that's why you have a wrecked consumer, you have housing market concern, you have a variety of reasons, people hurt by the interest rates, and you have the oil price collapse. We actually have right now, for the demand that's in the economy, which is low, a glut essentially of oil and dollars, and a shortage of silver and platinum, and a potential future shortage in gold in terms of private hands, but not at this point so far. So, hyper stagflation, the 1970s only much larger by degree, scale, and intent.
Francis Hunt portrays silver not merely as an investment but as a strategic form of survival in an era of monetary decay. He urges investors to think in ounces rather than in dollars, as fiat valuations lose meaning in a system dominated by debt and inflation. For Hunt, silver represents both opportunity and protection, a bridge from the collapsing fiat world to one grounded in real value. If his analysis holds true, the coming years could mark one of the most dramatic wealth transfers in modern financial history, from those holding paper promises to those holding physical silver. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.